Hello, this is Bob Steele. In this video, we will take a look at Chapter 8, Learning Objective number 3, which is to prepare an income statement under the variable costing. We're going to take a slide back before we go forward, and we're going to take a look at the unit cost is determined as follows. So remember, we're looking at the absorption cost and the variable costing, and we're calculating the unit cost here. And the difference is that the fixed portion of the overhead is being included in absorption. That's the kind of the traditional method that we look at. We try to put everything into the product cost, even though the treatment of the variable cost and the fixed cost have different behavior when we look at the number of production as production goes up. So in this case, we're going to take the 150 divided by the 25 and include that 6 in absorption. In variable costing, we will not do so. We will not include that in there, and we'll see the difference of that in the income statement as we go forward. So here is the income statement. We're selling 20,000 units at $30, same as we looked at under the absorption costing. That gives us the 600. The difference being here, starting with, we exclude the fixed manufacturing cost. So we've got cost of goods sold, 25,000 times 10, and that's the 250. So then we have the zero beginning inventory, calculating cost of goods sold, which is beginning inventory, plus cost of goods manufactured, 250, gives us the cost of goods available for sale. Then we're going to subtract out ending inventory, the amount that is still there at the end, which in this case happens to be 5,000. And we're going to multiply the 5,000 times that 10, gives us the 50. The 250 minus the 50 gives us the variable cost of goods sold, 200. Now, we're also going to put up here the variable selling and administrative expenses, and that is going to be the 20,000 times 3 gives us the 60,000. The 200 plus the 60 gives us the 260 here. We have basically a new term here, a contribution margin. The contribution margin is the 600,000 minus the variable costs of 260,000 gives us the 340,000. So our contribution margin is 340,000. Then we're going to take out the fixed costs, both the manufacturing overhead as well as the selling and administrative costs. Those add up to 290,000. Therefore, we have the 340 minus the 250 gives us our 90 net income. So if we were going to try to reconcile these two, we got the absorption and the variable costing. Let's compare the two. We have, under the absorption costing, we have included in cost of goods sold and ending inventory, we have the fixed costs of manufactured, because remember, we're trying to include that in the costs of our inventory, the cost of inventory that is either sold or still in ending inventory, as compared to the variable costing method where we're not including that fixed cost in the cost of goods sold or the ending inventory, meaning it's not included in the cost of our production. Instead, we expensed it all as a lump sum when we incurred it as a period cost. So the difference in terms of timing, when is it going to hit basically the income statement, is that the variable cost method will expense the fixed costs when we incurred them rather than when we sell the goods. So that would be a timing difference. If you reconcile the total of these, it's going to come out the same, meaning that the variable manufacturing cost and the fixed costs come out to 400. The variable and the fixed come out to 400 either way, but we do have this timing difference as to when they're going to hit, this expense is going to hit the income statement. Okay, so reconciliation report, income under the absorption and variable costing, objective number 4. So if we were going to try to reconcile the two, so if we had remember the income statement is going to be different. Over the long run, it'll be the same because all the costs, all the expenses are the same, but there's a timing difference as to when we expense the items. So if we were using variable costing, we came up with this 90,000, and if we were going to try to reconcile to what it would have been under absorption, we could do a calculation such as this. We could take the fixed manufacturing overhead, which is the 150,000 divided by the units produced. That is, we did this calculation before. That is what we're going to say is the $6 per unit that we would apply basically to the units for the variable costing. So then we're going to add manufacturing overcosts deferred in the inventory. So that's the 500 the 5,000 units in ending inventory times our $6 per unit gives us that $30,000. Therefore, the 90 plus the 30, that's what the absorption costing would have been. So then we're going to explain the implication of absorption and variable costing for cost volume profit analysis. So basically the reason that we would use the variable costing is for cost volume profit analysis, or one of the reasons we would take a look at it. And it has to do with those differences, once again, between the behavior of the costs, between the behavior of fixed costs versus variable costs as production goes up. So, and that difference, remember, is that, as production goes up, variable costs go up in a fixed way, and as production goes up for fixed costs, they stay fixed. So there's a difference in that behavior that it makes it difficult to make some decisions in absorption costs, and it makes it easier for us to make some kind of managerial decisions in this terms in a cost volume profit analysis. So cost volume profit includes all fixed costs to compute a break even. So variable costs and cost volume profit are consistent, as both treat fixed costs as a lump sum. So the idea being that if we were trying to do a break-even analysis, which is a basic analysis in terms of seeing a managerial decision to see how our business is doing, and we may do a profit analysis as well, the first thing we would look at is basically we're going to take a look at our fixed costs, and we're going to divide that by our contribution margin oftentimes. So and that's going to mean that we're going to have to break out variable costs versus fixed costs. So this variable costing method allows us to do that type of calculation much more easily. The absorption costing defers fixed costs into inventory. Absorption costing is inconsistent with cost volume profit because absorption costing treats fixed costs as a per unit basis. So that's basically the reason why we would have this difference between the two. And that is it for this one.